I don't think anyone's talking about stagflation today in terms of strategic portfolio management. I think what you do now is you price out stagflation. Stagflation is not going to be the challenge within your portfolio. We could go through the economic arguments why the disinflationary pressures from a technology-oriented economy, but you remove stagflation, and I think what you do is you reintroduce a growth strategy.
Right.
And that's what's been occurring for the better part of the last 6 to 8 weeks. That's what I've personally been doing. In the Joe T ETF, I spoke about the rebalance on the first day of August for the first time in 6 quarters. We increased our exposure to technology. We increased our exposure to growth. We didn't walk away from the places which we were already overweight, like financials. We took a barbell approach. We still think energy is a great risk hedge against maybe a fallback in the economic conditions, but you move a little bit towards growth, and I think that's been reflected by an outperformance of growth over value of nearly 10%, narrowing that performance gap from where it was, where it was 20% back in June.
So, Jim, over to you. Yesterday, a lot of discussion about we've reached peak inflation. I don't know if we have or we haven't. 1 month is not going to tell us that, but certainly a better than expected report.
Yeah, definitely not time to spike the football, Frank. But in football jargon, we just picked up a nice first down. Let's not get carried away. Let's get back in the huddle and move forward.
Was it a run or a pass?
It was a big yardage play, I'll say that much. Now, the camera can't show it, but I've got Steve Leisman over here to my right, and I'm sure he's going to key off of everything I'm saying. So I don't want to get too carried away, okay? But this does matter, and here's why. It has been literally a year and a half since you've had a CPI report, Frank, come in better than expectations, meaning lower than expectations. Think about that. A year and a half that you haven't been disappointed in the CPI. That's a breathtakingly long period of time. Hat tip to Joe in my office in Philadelphia for giving me that data, by the way. But what it is an indication to me, you don't normally see economists and the analyst community get it that wrong for that long. It's an indication to me that we are in a brave new world post-pandemic. And that's many ways that we see that, but one of which is this prediction of inflation has become very hard. Now, possibly, we're going to see that pendulum sweep to the other direction. And, Joe, this is to your point about sentiment. If you now had next month's CPI, and we've just gotten the first reading for this month, but if you got next month's CPI coming in better than expectations, then maybe you can really lay a claim that the Fed might only do 50 basis points in September, 25 and 25 thereafter. We peak out at 3.5. Which is what the market expects, okay?
Right.
And that would be very kumbaya, very kumbaya. The market is not adjusted to going to 4.5. It isn't. It isn't. It's not adjusted to going above 4%. So that's kind of where the market's teetering right now. And one day like today is a big first down, but the ball is not in the end zone.
Yeah, I want to correct myself really quick. 10-year yield at 2.772. I don't know what I was reading over there. Maybe eyes might be getting bad, guys. I don't even know. But I'm going to keep this football analogy going. Jason Snipe down in my hometown of Philadelphia. Since you mentioned Philadelphia, Jim, was this a big pass by Jalen Hurts down the field where we're seeing tech rallying on this better-than-expected inflation report?
I love the football analogies that we're rolling with this morning. So, yes, I think it absolutely is very positive for the market. Clearly, as Jimmy's been talking about for a while, I mean, commodity prices have been rolling over. Oil futures have been coming down. So on the headline, I think the market expected this to come in a little bit lighter. But I'm speaking to core right now. I think core came in also a little bit lighter. Shelter costs have been a concern for me going forward. Those are the more sticky part of inflation that I think is going to have a little bit longer for it to take a little bit longer for it to really abate and moderate. So I think the markets are also looking towards, and this is what Jimmy just mentioned, Fed policy going forward. So maybe in September we don't need to go as hard as we've been talking about, or they've been telegraphing. Maybe 50 basis points is the answer, in September. And I think the market's responding. And obviously you see the NASDAQ up close to 2.7% today. So I think that's really the narrative that's playing out right now.
Kari, I'm going to come over to you. You got to come up with your own football analogy on this one. But what do you see? How do you see this impacting the markets today, but also that big meeting in September? Do you think this changes the Fed's policy and strategy at all?
Well, I think that we have lost interest in the Hail Mary pass. So we have stopped thinking that we need some resurrection from the Fed to bring us back to something that we could stabilize from. The market seems to be doing this on the back of slightly lower inflation numbers. All we really needed was something below the 8.8 expectation, and we got there, so we're 8.5. But really, this seems to be more of a rally based on the bond market, which may have peaked at, as Joe said, around 3.5. It's come down a fair amount, so we're trading to 2.7 to 2.8, and that's comfortable for the market. That's where we have thought we were going to head, where we can start to see growth stocks outperform, because the discounting mechanism of earnings way out into the future is much more favorable if interest rates aren't going to keep moving higher and the Fed isn't going to keep doing 75 basis points for several moves. We're in a slowdown. It may be that we're in a slight recession, but it doesn't appear to be a severe recession. And if we can stay here with some comfort and inflation slows down over the next 6 months, I think the market can keep rallying. Our concern, and I think the major concern that bulls might have about the market, is whether it can broaden out or whether it stays too narrow. And there's a little chart that Vinny did that shows that the top performing stocks over the last 6 weeks, since June 16th, when we bottomed, have been the stocks that went down the most. You know, there are 39 stocks that have moved up over 50%, and 30 of them were names that had fallen over 50%. Many of them are meme stocks and Cathie Wood, ARK Invest stocks, and Robinhood names, Coinbase, Roblox, AMC. Of course, the bigger names have moved, but we want to have this rally be broad enough so that it carries the whole market and not just a segment of the market that's very volatile and can move down again and carry the market to some extent with it. So it's nice to see a broad advance today.
Kari, some great points there.